starting to see some of that poking its head, talk about digital dollars. Still a lot of people without jobs. It seems like everywhere there's these help wanted signs. And I just wanted to get your assessment. What the heck's happening?
Well, right now, I think the most important way to think about it is in rate of change terms, and that's kind of the biggest disconnect that I think some people have, where you have to take into account both magnitudes and rate of change. So basically, last year, of course, we had this massive deflationary shock. You had a lot of demand destruction from lockdowns and the pandemic and things like that. So we printed a ton of money, and that's the combination of fiscal spending and then the Federal Reserve creating new base money to buy most of those bonds. And so that unlike, for example, just doing QE alone, that money did not just stay in the banking system. It actually got out to people's bank accounts. It went out in the form of stimulus checks, unemployment benefits, PPP loans that turn into grants. In most cases, they get forgiven. Extra unemployment benefits, all these different kind of, policies went out. People got checks in their accounts. So, people's checking accounts, savings accounts went up. And so you had that kind of weird dislocation where fewer people are working and yet their income's actually above trend for a period of time. And so for a while they couldn't really spend it. They couldn't really travel anywhere. They couldn't do it a ton, right? So they mostly just saved it. They bought extra subscriptions and things like that, but they really didn't kind of circulate it too much. But then as things started to open up in later parts of 2020, and then especially here in 2021, we're seeing that money kind of pour back out into things. We're starting to see all sorts of, shortages from, people were off of work for a while. And then also there were kind of like weird demand dislocations, right? So more people bought homes all at once. And so we had lumber issues like sawmill bottlenecks. We had semiconductor shortages. We still have those taking place. We have shipping issues, right? So there's only so many container ships and containers out there. And you had kind of dislocations in shipping. And so when you have the combination of a lot of increase in broad money supply at the same time as there are really real constraints on some of these supplies and services, goods and services, you start to get price inflation in some of those. And then in addition, we've seen start like kind of like wage inflation creeping up a little bit, partially because people have been given pretty big benefits, whether they're working or not. And so basically, if you're a business that wants to lure people back to your workforce, you're in the position where you have to kind of do bigger sign-on bonuses or wage increases in order to kind of maintain that labor. So we've had some labor shortages, especially in kind of the service sector jobs. And but I think one of the things now is that we're experiencing a pretty high level of inflation. So official CPI hit 5% roughly this past month. And right at the peak where everyone's going to talk about inflation, what's probably going to happen actually is we're going to roll over a little bit because the base effects are a little bit harder as you go later into the summer. And some of those stimulus effects are kind of gradually wearing off. And so I think, as we look out later in this year, we're going to have above trend inflation, but this kind of May, June period might end up being kind of the local high watermark for at least for a period of time.
Is this a hold for a decade or trade and step in and out through the correction phases or hold through?
I think it depends in part on someone's investing style. The way I'm approaching it is I kind of have a base commodity producer position where I'm just kind of buying and holding a big chunk of commodity producers and certain commodities as well, ones that are, like say gold and silver. And then, around that kind of base position, I'm willing to add some chips to the table, take off chips to the table based on what happens with sentiment and overbought conditions. And so, for example, I was really bullish on copper in the mid 2020. But then we had, over the next, say 6 to 8 months, everybody was bullish on copper. It was like the most consensus thing in the world, and it went up pretty dramatically, got overbought. Some of these copper stocks really exploded, and even though I think that they probably still have a longer runway ahead, I trimmed those positions because it just became a very consensus overbought trade. And so basically, my kind of approach here is to kind of rotate into whatever commodities are kind of out of favor, kind of build up positions, dollar cost average into positions when they're kind of weaken, and then kind of basically take a little bit of profits when they spike, when they go up pretty substantially when everybody wants them.
We're seeing all these countries talking about reducing carbon, and everybody's now saying nuclear. And then also Shamath, did you see his clip the other day where Shamath said on his podcast that there's somebody introduced him to uranium and there's a huge play? So just wondering your thoughts on all that.
Yeah, I mean, so I really did a lot of the research last year, and so by October 2020, I became bullish on uranium. I wrote about it. And I continue to be. I mean, it's one of those things it got pretty hot for a little bit, and so it's kind of like it's a little bit less exciting than when I wrote about it in say October 2020. But that I do think it's a multi-year play, and so even though it can cool off for say 6 months at a time, I think that uranium and uranium stocks are likely to do pretty well, as we head deeper into the 2020s decade.
How about gold and silver long term? Still, silver still hasn't been able to break above 30. Gold hasn't been able to revisit 2000 plus. Um, and it seems like the majority of the macroeconomic factors, you would think would favor it. You've talked about real rates. Give us your thoughts on gold and silver and how you think they'll fare moving forward.
I'm still long-term bullish on them. It depends. Again, I think they're going to come in cycles. And so if you look at gold, for example, gold, real rates as measured by the 10-year treasury minus inflation break-evens, which is like the tips markets, kind of forward inflation expectation, which isn't even a great measurement because the Fed's buying tips, right? So when the measurement become when like the measurement becomes a target, it ceases to be a measurement is the example. But that's they're all paper markets. So the gold paper market follows the inflation paper market. And so basically when you look at say 10-year treasuries minus the 10-year break evens, that's the real yield that the gold market has the closest correlation to. And for example, that hit a low back in August 2020, and it's started to rise, and then it kind of rolled back over, and so it's kind of come back down, but it's never really gotten to lower lows yet. And so because we've had inflation break evens rise, we had nominal yields rise as well, and so we've been in this kind of choppy pattern for gold, which makes sense when you look at the real rates argument. And so over time, I think the 2020s are likely to be in a period of persistently negative real rates. I do think we'll probably see a period where we go into lower negative rate territory than we saw in August 2020. I just don't know if that'll be in say this year or not. But I do think as you look out further, that's certainly a place I'd want to have some of my assets in gold and gold miners, and probably silver as well, because you're still looking at a period of cash devaluation, bond devaluation, and so I think those are nice hedges. In addition, if you look at say gold and silver miners, they're actually pretty attractive with current gold and silver prices. And so even if you're kind of lukewarm on the underlying metal, and you think, okay, let's say gold and silver go flat and choppy for a year or so, those miners in many cases are making pretty good free cash flow at current levels, and they're not too expensive on a price to free cash flow basis. And a lot of them have plowed that free cash flow instead of, if you look back in 2011, a lot of them were whatever money they had, they would just spend it in more capex or they'd make acquisitions, and a lot of them didn't really produce a lot of free cash flow, even though they had really strong markets in their underlying metal. And now what they're doing is they're basically just all the profits that they're getting from those higher prices, they're paying off debt, they're strengthening their balance sheet. Some of them are paying dividends to shareholders. And so in many ways, the gold and silver stocks have better balance sheets and better free cash flow than they've had in, modern history.